Today, I bring to you the top 5 things I wish I knew when I started day trading. If someone would have shared just a couple of these things with me, I can tell you right now, I would have saved tens of thousands of dollars and countless hours getting to a consistent and profitable state of trading. I definitely think that all 5 of these trading points will go a long way in helping you guys avoid a lot of the mistakes and wasted time while getting started with trading. This is going to be a good one. Please consider hitting the subscribe button as we go through these 5 points. Number 1. Stocks on watch. We all see a bunch of stocks come up every morning on the scanners, but how do you even know which ones to really start with? You probably heard me say, stick to stocks that have catalysts. If you can't find any news on the stock, I would highly caution you on trading it, or at least momentum day trading it. Earnings is going to be the best catalyst, and that's why we try to become really aggressive during earnings season. Earnings will definitely be responsible for driving the biggest moves. The next catalyst is going to be company-specific announcements. Are they making some kind of acquisition, or are they announcing a partnership with a behemoth like Google, Apple, Amazon? Is it a smaller company entering into a contract with a giant one? Those are things to really look out for. Those are catalysts that you want to trade. A couple of the ones you want to stay far away from are analyst upgrades and downgrades. So anything out by any type of analyst, any type of comment, upgrade or downgrade, I would stay far away from. You have to understand from the position of the analyst. Most of these analysts have a position on the stock, or they're being paid to write these because someone else that they have an interest in has a position on the stock. You have to understand that they just aren't simply writing these reports because that's what they ultimately think the stock will do. There's ulterior motives here and behind almost every upgrade and downgrade. Any analyst out there that's being honest with you will tell you this. That's why they're so unpredictable. We don't really know what's going on behind the scenes, so just stay away from it altogether. Anything analyst related is not a catalyst. The second one to stay away from is offerings. We see stocks all the time that'll have an offering. A lot of times, stocks that have been on a big run or just made a huge move will come out with an offering. Yes, it's news, but it's not news relevant to us. Why? Because again, there's a lot of different scenarios on how an offering could be structured. It could be a value add to the stock, or it could be very negative. We don't know. What I'm getting at here between analyst comments and offerings is that there's no consistency. I can't tell you when an analyst comes out with a downgrade that the stock will go down. I can't tell you that when a stock has an offering that it's going to go up or down. But with catalysts like earnings, it's a bit different. If we have earnings on a stock and it's bad earnings, and the forward guidance is negative, I can pretty much tell you 80% of the time that stock is going to go lower. I can tell you the different situations that are going to arise from relevant types of news, like earnings, or Carl Icahn takes 2 million shares of Apple. Those are big catalysts, and they provide momentum moves for us to trade. Analyst ratings, offerings, comments, those do not. So stay away. If someone had told me that these are the catalysts to pay attention to and the rest just don't even look at, I would have gotten a lot further a lot sooner. So when you're making your daily watch list and you check the news and it's not either earnings, company announcement, or an activist investor, move on. Number 2. Less is more. You guys have to understand that more trades does not equal more money. I can't stress that enough. I can't say that enough. I know as a new trader, you feel like you're not getting work done if you're not trading, but I can assure you 110 times over that less is more. Wait for the stocks to set up with your criteria. Wait for the proper patterns, the proper technicals, the proper news. And when you get that, you take the trade. Don't try to trade everything that moves because you will get chopped up. You'll grind down an account. How do I know this? Because I did it. It takes a really long time to understand less is more. It's kind of a counterintuitive thing. You know, if I take 10 trades, then I have more opportunities to make even more money, right? And that would be somewhat logical if you didn't really know much about the market. But if you know anything about the market, you know you gotta be patient. Take as few trades as possible, waiting for that one that has the best possible setup to make that huge move. And when you get it, swing hard. Don't feel like you should be trading all day long. Don't feel like you should be trading 20 times a day. And don't feel like if you don't see anything that looks good to you and you don't take a trade that you didn't get work done. What you're doing when you're sitting there waiting for an actual trade to present itself, you're actually doing one of the hardest things, and that's developing the skill of patience. So you are doing work when you're sitting there inactive. You are actually developing that skill of patience. I can tell you right now, I probably rank that in the top 3 skills that you need to be a successful trader. You have to have it. Because if you're just all over the place, you're gonna get chopped out of an account. Be focused and aggressive on the trades that are setting up. That will get you much further than trying to trade everything that moves. There's traders out there that do well trading everything that moves, but I can tell you, you will have much less risk and most likely more success than those guys that are trading everything that moves. I promise you. I'm not saying that trading everything that moves can't make money. What I'm saying is that the ones that are patient, the ones that understand less is more, will make more money than the ones trading everything. All right, number 3, trade the trend. I know, you probably heard this before. People say it all the time, but let me go a little deeper than what you probably heard before. I used to trade a lot of parabolic reversals, and I used to do really well on them. But when one didn't work, I would take a big loss, and it would wipe out a lot of the gains that I made with the ones that did work. Where I'm going with this is trade the trend. It's much easier and much more conducive with trading a large position. As you guys progress and start to trade larger positions, you don't want to run into the hurdle of trying to accommodate a setup to your position size. So you should just prepare for that now. Prepare for that while you're still building up your strategy, while you're still building your trading skills. What I mean by this is if you're trading in the trend on these high volume momentum names, then you can gradually scale up your size and not have to worry about those types of trades providing the liquidity you need to get in and out. If you're trading a parabolic reversal or you're just trading against the trend, you have to be a lot more diligent and quite a bit more methodical on how you're sizing into these positions. You can't just buy big blocks as the stock is just tanking. You just can't do it. In a momentum trade, when you're going with the trend, you can buy heavy blocks into the trend. It's much easier and much less risky than it is trying to pick the place where it's going to turn around. I used to trade against the trend because it was interesting. It was fun. I liked being able to predict where the stock was going to turn and make a run back to the downside or upside. And if I were to take a different approach to trading, maybe a swing approach or a little bit longer term approach, I would be much more of a contrarian, selling the rips, buying the dips. But we are momentum day trading. So you want to trade with the trend so these movements can absorb the positions you're trading. Let's say you're trading reversals. You're doing pretty well, you're generating some cash, but then there comes a point where you want to size up a little bit. This is a whole nother hurdle you have to deal with. The liquidity that's available to you in a stop out that happens in a trend is much different than when you have to stop out on a parabolic reversal trying to take the downside. Your slippage is crazy, and taking giant size is just gonna wreck you. I've done it. And it's a whole nother hurdle in itself to figure out the right sizing approach into these reversal type trades. But when you're trading with momentum, with the trend, this hurdle never has to happen. You never have to come into this situation if you just prepare for that now. Yes, you have to accept a little bit more risk as far as stop distance goes and that sort of thing, but overall you won't have to worry about your sizing. These stocks can absorb the type of volume that you're trading. It's not an issue. Reversals can be a good approach, but I can tell you, they will never provide the home run trades that a trend trade can. It'll be very, very infrequent will you hit home run wins on those type of trades. Can they be a secondary strategy? Absolutely. You know, when you see something falling out of the sky or you see something rip into the moon, you can look to take a reversal on that and look to lock up some profits maybe when the day is slow. Not as your primary strategy, not as your go-to, because it won't be able to sustain the volume that you're trying to move through the stock. All right, I'm talking 5,000, 10,000 shares. That's it. And if you trade with more than that, then absolutely these reversals are dangerous as hell. If someone had told me, stick with the momentum trend, it'll make my job a lot easier, it would have saved me a lot of time and a lot of money trying to figure this out. Number 4, pre-market patterns. So here we're going to dive a little bit deeper into some technical based points. And it might sound kind of silly to some of you. It sure did to me when I stumbled across this and saw a lot of consistency in what I'm about to talk about, but it works. There's no question it works. Acknowledging and recognizing the pre-market pattern. The first one we're going to talk about here is the pre-market drift. Basically, all that is that you're gap down and you're making lower highs and lower lows. You're fading lower. You're just drifting lower. This is something that I can pretty much tell you, if we get the right kind of open, it is going to continue to the downside. I call it the pre-market drift because that's what we're doing. We're just drifting lower, drifting lower. What you see here on the screen is the pre-market drift. Here we have the SPY. We have a gap down and we have a lower low here and a lower high, and then another lower low, and then a lower high. This looks even juicier because we're up against the VWAP and a gap pivot level, but I can tell you that if we get the right type of open, this is going to fall even further. And what actually happened on the day was a little bit of a retest right after this. Pre-market speed line here, that was the retest into the VWAP and level. As soon as the open occurs, we should get a flush low. Here's the open, and we go lower. So again, this is lower lows, lower highs in the pre on a gap down stock. The next one we're going to be talking about is a pre-market basing pattern. This is going to be very similar to a pre-market drift. However, it's going to have a basing pattern to it, right? As you see here, we have our gap down. Boom. We try to come back up a little bit. We fade lower, and there's our new low, right? But that low is not lower, so we don't have lower lows. We do have a lower high, but again, not a lower low. So whenever I have a stock that's gapping down and we're not making lower lows, and technically it kind of has a higher low going into the open, which is what this would be right here, right? We didn't even hit it. We didn't test it yet. Nothing in the pre. If it was going to continue, we should be having a fading action, right? A drifting action, but we don't. It's being bought up off of this level. Whenever this starts to happen, I would expect a pop on it or a rip to the upside before it comes back, if it comes back at all. What I see a lot of times from new traders is they see a stock gapping down. They say, you know, this looks good. Let's look for a short on the open. But what happens is if you don't have the pre-market drifting pattern or you have a higher low coming into the open, you need to be very cognizant of the fact that this is probably going to rip to the upside before it comes back, if it comes back at all. So let's go ahead and see how this turned out. We're going into the open here. Right as we start going through in the open, this is where those newer traders try to get short. Bam, they're stopped out. And what happens? We're going to rip to the upside. We had a base in the pre. Because it didn't have that pre-market drift, we can't look at it for continuation short. So it's very important that you understand and recognize what the stock is doing in the pre-market. Now, the pre-market drift works in both directions. Essentially, it's the same thing as the pre-market drift down, just flipped over. And a pre-market base is basically a gap fade setup where there's a high, a lower high, and then a break of support. Exactly the same thing as what you just saw, just reverse. So real quick, I want to show you what the gap fade setup looks like too. The stock is gapping up. We do have a pre-market drift going on, right? And we make our high, we come back, make another higher low, and then let's see how this works. We push up here, got a little bit of a wick, but then we can't get through that last high it just made. Not only that, but just now we just broke the support that it was using for the pre-market drift, right? So now we have this high here, lower high here, and a break of support. This is the exact same thing I just showed you with the pre-market base, only this is a gap fade. When a stock is not making new highs, that doesn't say strength, right? We're coming right into the open. There should be strength here. More people should be watching this and buying into this if they believe it's going to go higher. But instead, look what happens, right? We have a resistance coming through. Once it tried to push through, it's going towards VWAP, falling through VWAP, and right back down towards that last pivot. So those three right there are all you need to know. The pre-market basing, the pre-market drift, and the gap fade. The gap fade is just an inverse of the pre-market base. The pre-market drift pattern is the same in both directions. On a long, you want to see higher lows and higher highs. On a short, you want to see lower lows and lower highs. Very straightforward stuff. If you haven't paid attention to the pre-market patterns before, definitely start trying to do it now, and you'll see it'll give you some really good insight as to what's going to happen out of the open. And the last note here, if the move happens in the pre-market, stay away from the stock. All right, if you see a gap fade setup occurring, but it breaks and fades all the way down back to its initial support that it gapped from, you need to just stay away from it, all right? If you see a pre-market base occur and then a rip happens, it just rips right back up to resistance in the pre, stay away. That was the move you were trying to catch. That is what you were identifying, and it's gone now. Just let it go. It's going to be really hard to trade this thing into the open with your bias being messed up like that. Now, number 5 is a fast time frame chart. If someone told me back when I started that I should consider a 30-second, 15-second, or a 24-second, which is what I use, chart, I would have laughed in their face. How can you watch that fast of a time frame and not get confused by all the noise? And I totally understand what they're referring to. However, once you understand how to read the fast time frame, you will have a significant edge in not only your entries, but your stops and your exits too. Why? Because you're seeing the inside action, the actual price action that's moving the stock. The type of trading that we're doing, the high volume, momentum trading, you need to be able to pinpoint these specific areas of where to get into the trade with the least amount of risk. And you can really only do that with a fast time frame chart. Take a look at what I'm talking about. So with a fast time frame chart, sometimes the candles are going to look a little weird when there's not a lot of volume going on, but this is a pretty good example I found to show you. As you can see here, we have a gap down on the stock, have a little bit of a fade, right? Lower high, lower low, lower high, and we're going into the open here. All of a sudden, we start to get above this high, and we didn't break this low. So what does that mean? That means that we have a little bit of a pre-market base going on here. So what do we expect here? We're going to expect a rip to the upside or a pop before a turnaround, right? See, we hit the base. We're not going through it. So this is a pre-market base. Here comes the pop. And here we are running now into the pre-market high. We do have volume on this, but because we couldn't get through the pre-market high, we still have the weakness. The gap down, the base, the pop, all was expected. And then let's see how this plays out further. Where are we going to get our entry, right? We want to short this. What you can see here is as soon as we reject off this level, all you need is a pivot put in. And this is true for every strategy, every setup, whether you're going long or short, it doesn't matter. All you need is a pivot put in the direction you're trying to trade below or above the level. So right now with the pre-market base that we have, this is our level. Okay, we have 926. We don't want to short going into this level and then get pulled back to VWAP and stop for no reason. You could have maybe shorted at the high here, but again, because this is a pre-market basing pattern, this could really rip. There's no reason this couldn't rip. Look at the volume. This didn't say we were going to just rip the other down, right? This said we could possibly go right through this and higher, but we didn't. So what are we waiting for? We're waiting for a pivot below support to take our short. And just so you guys know what I'm talking about, a pivot is a lower high or a higher low, depending on the direction you're going. So for a short, it's a lower high. For a long, it's a higher low. Remember, your job as a trader isn't to make money. It is to manage risk after identifying your edge. An edge, by definition, is a setup that has a statistical advantage over time. As long as you're identifying your edge correctly, then the only thing you have to do after that is manage your risk. Now let's see how clear the fast time frame chart is when we start breaking through this level. Check it out, right? We got our weakness, we're fading down, we're rejecting the VWAP here. Do you short right here? No, right? Because this could just rip and pop back the other way. We need a lower high now underneath this level before we take it. Not only that, but when you have these fast time frame candles, you can see the volume so clearly. Look at this. We have ramping volume as we're getting down to the pre-market base. Boom, right here. Look at our risk. It's defined right here. 25 cents of risk right below the level. The 24-second chart or a fast time frame chart, 15-second, 30-second, doesn't matter. Shows the same thing. I just like the 24 myself. I've done a lot of back testing with it and I stick with it. All right. Now that we have our setup right here, high volume on the break, low volume on the retest, right below support, how's this going to play out? We're fading. Right, here's another lower high here. We're breaking through the lower low. Now we're just kind of drifting, right? There's a pop and it doesn't hold. We're fading lower, fading lower. Again, we have declining pullback volume, declining green volume on this push, but then ramping at the end here. That's very good to continue to go. Look, now we have another piece of structure to put our stop on. Now let's see what this looks like on like a 5-minute chart. Okay, so here's our 5-minute chart. We're gapping down. We have a little bit of base going on here. This purple line is the 5-minute 200 EMA. So you're not going to want to short into that. Like I said, a pivot below that level is what we need. All right. And let's see what that looks like on a 5-minute, right? We see the rejection of the level. We're coming back into that 500, or the 200, which you don't short into. We're going through it. Now look how clear and defined it was on that 24-second chart. Looking at this 5-minute chart, we just slide right through it. Right? Big old red candle straight through, another red candle, another red candle. How do you know if you're chasing or not? How do you know if there's any consolidation going on? How do you know if you're at a level where you're constantly getting bought up? You don't. You can't see it. And because what we wait for is a lower high on this short setup here, We never got any type of a real high. We just have candles, fading candles. Right? So you couldn't have got the entry on a 5-minute chart. You would have just been sitting here waiting and then watching everyone else make their money and go home. That's why when you're trading momentum and you're trading out of the open because you want to catch that big move, you need to use the fast time frame chart so you can see the inside action of what's going on. What I was doing in the beginning of my trading was trying to trade off a 5-minute chart. I would see these stocks moving like this, right? They're just dropping. It looks fantastic. But because I'm on a 5-minute chart, I'm not getting the cues and the information that's available to me below this level of chart because I didn't know about it. I didn't know to look at that. I didn't understand what I was seeing when I went to that chart. So when something like this is happening, I start thinking like, do I get in here? Do I just jump in? Where do I put my stop at? Do I put it at the high of the last candle? No. The algos know that, and they're going to come back to retest that to blow people out. You don't want to be like everyone else. Everyone else doesn't make it doing this. Everyone else fails and thinks the market's rigged. Sometimes just jumping into it would work, but a lot of times it would whip against me, and I didn't even know the right place to stop out. So you have to know the right place to enter, the right place to put your stop, and all of that comes from the fast time frame chart. Look, we literally have almost no information in this entire drop here. But on the fast time frame chart, look how clear it becomes. Look at this. We got our consolidation triangle that happened here, the breakthrough, our retest. So this would be our entry right here, right? Our stop would be above that level. As we fade, we move the stop. So the stop would then become here, okay? As it fell again, the stop would go here, and then it falls again, the stop would go here, and then it keeps falling. So at any of these points, if you actually got stopped out, you were in the profit already. You're not using these huge 5-minute range candles. You're not just looking at a bunch of red bars hoping that you continue to go because you got in way late. And using these fast time frame charts, you can get such a great sense of where these locations are, right? What levels is there resistance? What levels was there a little bit more buying than not? This is all important stuff that you need to get a feel for what's happening on the move, and all the way up to this point here, we were making lower lows every single time. We're just trending down, trending down, trending down. Then we come up here and all of a sudden, this low, we have a higher low. As soon as you're not making lower lows or higher highs on the fast time frame, it's time to consider getting out. The trend is shifting. We're either going to go sideways or we're going to go back up towards the VWAP. And I don't want any part of that, right? My directionally driven trade is now complete. Looking at that out on 5-minute is crazy, right? Look at this. This is the same thing, the same arrow, the same bottom thing. We would have gotten out in this area right here because we stopped making lower lows. But you didn't really know to get out on the 5-minute until this triangle here broke upwards, right? So you would have lost out on almost 50 cents of profit there. See what I'm saying? So what I'm getting at here is the subtle cues that a faster time frame offers you guys. It's amazing. If you understand how to watch it, if you understand how to read it, you know what to look for, which is higher highs or lower lows. You will find yourself ahead of the move much of the time, right? You're not going to have to wait for a huge move to come back against you and break the other way anymore. You're going to see, hey, momentum has died out. We're no longer continuing higher well before any 5-minute candle tells you this. Faster time frames are a big key to my trading, and they can definitely help you too. It takes time though. Don't get overwhelmed. I know it looks choppy, but when you're watching in real time, it definitely helps you see the trade develop. If you made it this far, I'm going to go ahead and give you a bonus number 6, and that's going to be volume. Using volume, reading volume, analyzing volume profile. That shit is the key, man. If I could give you the keys to the castle and this whole trading thing, it's going to be volume. We don't have time to go in depth on how to read volume and analyze profile right now. But if you found value in this video, if you learned something here today, please hit the thumbs up, subscribe, hit the bell icon, get notified when I drop the next video, which is going to be about volume. I would greatly appreciate it. It's free to you and it means everything to me. I hope to see you guys next time. Stay green, stay vigilant. Peace.